Hello, and welcome to The Rules of Investing, a podcast that gets inside the minds of leading investors, economists, and industry experts, and it's brought to you by Livewire Markets. My name's James Marley. I'm going to be your host today, and with reporting season on the ASX about to kick into full swing, my guest today is someone that has crunched the data on more results and the reactions from the market than just about anyone else. Rudi Filapek-Vandyck, editor of research website FNArena and popular contributor to Livewire, is with me to help you get match fit and in the zone for the upcoming reporting season. From the big picture on current valuations to the impacts of AI and the stocks to watch in August, this is going to be a cracking session. Now remember, if you're not subscribed to the Rules of Investing podcast, you can find it on all the major podcasting platforms, or you can sign up to Livewire Markets. It's free, it's easy to register, and we'd love to have you on board. Now, with that, I'd like to extend a very warm welcome to Rudi for our regular reporting season preview. Rudi, great to have you on the line, and thanks so much for your time.
My pleasure. The sound you're hearing is the rain coming down in Sydney on the moment that the interview starts. So they say in investing, timing is important. Apparently, with recording, it's equally as important.
I thought it was a sign that we're about to get rained down, this deluge of information on reporting season, and you're going to be our little safe harbour to help us get through it all.
I will definitely do my best, but after such an intro, half my work has already been done.
Yeah. Well, we were having a chat about what will we talk about today, and you sent through a few points, and a starting point: valuations. Are they high? Are they stretched? It's topical for investors, difficult one to answer, and I'm going to draw attention to an article that my colleague Kerry Sun put together recently, which effectively told people to stop calling markets expensive. They're at all-time highs, and what the crux of the article was, and it drew on some research from UBS, which was that the market has evolved, companies have gotten better, therefore we need to think about market valuations in a different light. So, Rudi, I guess, does that mean we need to get used to paying higher multiples? Should we be more comfortable with higher valuations?
I think the answer is yes, under certain circumstances, and not always. But we definitely need to stop calling the market overvalued simply because the valuation multiples are higher than we are used to. It is being said that generals always fight the last war. I've come to the conclusion that most investors invest in yesterday's market, and they need to invest in tomorrow's market, of course, because it's all about looking forward. I can't emphasize enough how happy and how glad I am that stories like that and analysis like that are being published, not just by me, but by others as well. Because I do think a whole change still needs to take place in the psyche of investors. And Australia being a typical value-oriented in market for such a long time, investors are constantly still thinking that something trading on a P of 6 or 9 is by default a better long-term investment than something that's trading on 96 times. And we clearly saw that over the past 15 years or so. That's no longer true. And in addition to all the arguments that are being and I completely subscribe to those arguments as well. But I do think there's also a very simple, more easy to understand metric to today's market as well, is that we still reason in averages. So we judge the market by the average PE ratio for the ASX 200, and we judge the environment for corporate Australia by the average EPS growth forecast for the ASX 200 predominantly. Now, in both cases, you can say that the market is so polarized these days and has been for such a long time. The market has at least been polarized ever since COVID hit. That's 2020, that's 5 years ago now. And on my analysis, the polarization is quite extreme in today's market. But what that means also is that those averages that we are used to watch for the PE ratios, for the EPS growth forecast, you can't take them at face value anymore. And the simplest way to view that in Australia is a big part of the reason why the PE ratio looks this high for the market is because we have 11% CBA of the index at probably trading at the highest valuation than any of us has seen in our lifetime. And at 11% of the index, of course, it's going to have a big influence on the PE ratio, right? And that's one of the reasons why the PE ratio is that high. The bigger question, I think, is should the market sell off because CBA is the all-time high? I mean, I know sentiment is important, but I would argue it doesn't need to. The other element also is of course, that resources remain a very important input in Australia. They are the second biggest index weight, and they too have an outsized impact on all the averages that we can calculate for the index. So I mean, I often smile when the next person is calling for the bubble to burst. I don't think there's a bubble. I think it's way too early to say there's a bubble. Are valuations high? Yes, they are. But there are particular reasons why that potentially can be justified, and I'm sure we'll talk about it over the next however this interview takes.
Well, one of the things you mentioned there was earnings, and we get told as investors over time, where the earnings go, so too will the share prices. The same note from UBS, or a more recent note perhaps, pointed out that we're about to get the second consecutive year of negative earnings growth for the ASX. Now, to your point, that's on average, but we've got all-time highs being hit at the time when earnings are falling. So what gives?
Yeah, so again, yes, you're right. At face value, we're on an all-time high. We have a PE ratio that we very seldom see on average, and we have not the second. We are in August will mark the third consecutive year of negative EPS growth on average for the Australian market. So you would think like it's all about multiple expansion. There's no earnings there, but that's not true when you look below the surface. If you look below the surface, the two largest components of the index locally, banks and resources, are weighing negatively on the average. Now, the banks are positive for this year, but it's not much, all right? And the resources, again, negative, both the mining companies and energy companies. So if you strip those out, then you see that the growth forecast for corporate Australia outside of those two sectors actually not that bad at all. I mean, it's more in the mid to high single digits EPS growth. You know what? The average long term in Australia is 5% EPS growth per year. If the forecast now is 6 or 7 or 8, that means there are large parts of the Australian economy that are performing above average. And coming back to the polarization that I touched upon earlier, what you will find in sectors that one company has performed and the other one hasn't, if you want to drill down to it, it's usually that one company actually has performed operationally and the other one hasn't. So earnings do count, not only in August, but also in the in-between seasons.
Yep. Banks, it's going to be hard for them to meaningfully move their earnings. They're flat-ish type businesses and have been for a long time. Resources, highly cyclical. Can you see a turnaround story in that earnings outlook? People have been waiting for that broader earnings picture to move into positive territory again. Are we going to see it this August?
It's going to be interesting. I think, and this is my view in advance, I think the question that will come to the fore for August, I think, is it not too early still? And that will be the question that will be asked for a lot of things. I mean, we've now had at least 3 years of large caps on average outperforming small caps. Is that going to reverse? I think the question will be, is not too early for that yet. We have subdued consumer spending. We have profit warnings from consumer spending related companies in Australia. Is that going to turn around in August? I think the question will be, is it not too early yet for that? I also think that the whole revival of the resources sector, too early, most likely. Are we going to see a big improvement in earnings forecasts? I think it's too early in August. The RBA has been very, very reluctant in helping out. Trump tariffs, it hasn't all helped. And I think maybe a more logical time will be February next year instead of August this year, which clearly will have some challenges for investors as well. You can also expand that to other sectors or to other themes. I mean, are we going to see a broadening out of the advantages, the benefits, the applications of AI across corporate Australia? Probably a little bit too early to see concrete results of that. If you take the really broad view that will this whole AI theme at some stage stumble and at least have a pause, that too, I think, will be too early for August. So I think that will continue. So I think that the challenges are lining up, and I know that the usual reflex of investors is trying to figure out which companies haven't performed yet and they might perform in August. I think the danger is that they will say goodbye too early to companies that have performed and that still have a lot of firepower to continue performing. And if you just look, for example, at the three corporate results that we've seen just prior to this interview, Champion Iron and Rio Tinto, two commodities, two iron ore producers, two disappointments. Both share prices went down. Both share prices have not performed over the year past. We had ResMed has performed all-time high, comes out with a result better than expected, share price up. I think there's a lesson here for investors. Don't say too early to companies that have performed that this is the end of the world, and don't think too easily that those who are in the laggards camp that their time has come to perform now. August might just be too early for that.
Yeah. Interesting. From the US perspective, we also saw some of the big tech companies, Meta, Microsoft performing really, really well. We had the IPO of Figma, which was just stratospheric in terms of returns, but connects to that theme around AI and some of that tech momentum that you've talked about. Volatility, it's been a big part of prior Australian reporting season. It's been evident in the US. Do you think that that's going to be a feature again? And how do you deal with it? Any tips for investors on how to take advantage of it?
Yes, well, I can easily say my personal position is probably the best starting point. So the portfolio I manage currently has 10% in cash. It was a bit more, but I did apply for extra shares in Xero recently. And so I have 10%, and I have, at this point in time, I have no intention of doing anything with that 10% because I worry a little bit that I might need it in August or in September because it might well get that volatile. And if it happens in the right stocks, then I'll be buying. And that's basically the attitude you need to have as an investor, I think. What worries me a little bit in that regard, and that's also research that was done by the likes of UBS in recent reporting seasons, and I believe Morgan Stanley did something similar as well. The average volatility in the last 2 seasons has picked up dramatically, like really significantly. So that basically means that if stocks fail, if somehow releases do not quite meet expectations, the punishment can be absolutely extraordinary in initial stance. That is obviously very devastating if you're holding the wrong stocks for the wrong reasons and you have no confidence in them, because there are your losses, even if you don't take them. But for the right stocks, and if you are confident that it's a temporary setback and the long-term story remains intact, the obvious observation to make, of course, that's an opportunity there. And I often are being asked, which one do you think it will happen, and which ones are your favorites? I've not been doing this for such a long time, and I've stopped predicting because you simply don't know. I mean, and in a very simple proposition, I'm still a long-term shareholder in ResMed. ResMed shares are now up 100% in 2 years. Can you imagine that one? I have no intention of saying goodbye to them. That they rallied very strongly over the past month into this result. And that normally can make you a little bit worried, because who tells you that that will not lead to a disappointment on the day? And of course, in this case, it hasn't. But there's no guarantees when you put all these elements together, and whether that matters in the immediate term is very much dependent on why you own stocks, what's your horizon, what does your portfolio look like, and probably the most important thing is how large is your confidence in that whatever happens in August does not necessarily reflect on the year ahead or the 2 years ahead.
Well, let's dive into a couple of important results and key results for people to keep an eye on. I've picked CSL. I know it's a company that you followed for a few years. I've followed it as well. And we had a number of commentators or fund managers on Livewire saying this result really matters for CSL because investors have been patient. The stock's been treading sideways for an extended period, and it's time for management to deliver on some of the promises around better margins and growth. What's your take on the outlook for CSL?
Yeah, I'm not so sure whether that's true. I think those people might be expecting too much, and the reason why that is because we still have Trump in the White House, and I don't know if Trump goes after healthcare costs in the US and is targeting big pharma, how much of that will also impact on CSL or will exclude CSL, etc., etc. While the share price hasn't performed post-COVID, what people forget and completely ignore, the company is growing at double digits. I mean, underneath the share price is a company that grows at double digits. I mean, it did that last year, and it has guided to do that this year, and it probably will equally guide to do that next year. So there's only so much that the company can control, and I think on one end you're right. Management has to now reconfirm that, and I think they are cutting costs as well to help them a little bit, because there is a lot of insecurity if you are inside the CSL bunker there. And there are signs I've noticed over the year that they're definitely feeling the pressure. They definitely feel like they need to do something, because shareholders clearly, they're not sitting there to have a share price that doesn't move. But in the same respect, I am very cognizant of the fact that it's not all in their power. Right? They would love to be in a position like ResMed is, where they can just have solid sales and an increased margin. I think just like with BHP, where they had to increase the capex and postpone the second expansion project in Canada with the Janssen Potash. I think the disappointment from CSL was that the return to the pre-COVID profit margin has been delayed now for twice. And from that perspective, I think they probably need to come out and say, like, no, we're on track now, and not delayed by another 12 months, because I think that would definitely be a big disappointment. And if they read the room correctly, that's exactly what they shouldn't do in August. Yeah. But again, we will have to see. But I'm not, if it wasn't for the whole anti-vax movement in the US that is now in charge of the government, I would not be that negative about CSL at all. I'm not negative now, but I am cognizant of the fact that they do not control. They have no control over certain things that can have even short term, can have a big impact still on market sentiment for the very least. What I do notice, by the way, is that in July, both ResMed and CSL share prices have rallied quite strongly. And that's something for investors also to take into account. Clearly, the market, for some reason, felt more comfortable in owning those shares after June in July than before that. And why exactly that is, I don't know. Because all I know is that Trump hasn't changed his views. But maybe there's more confidence out there that whatever comes out of CSL, operational at least, won't be bottom of the barrel.
Okay. Rudi, a couple of stocks that you've got your little Rudi microscope on for reporting season that that you think could be interesting to keep an eye on?
Yes. One of the ones I'm still very much into the AI mode. I mean, I believe that the skepticism that has descended upon the Australian share market will be proven misplaced. You will find that all those stocks that last year couldn't do no wrong because they had an AI label attached to them. The whole atmosphere has changed this year, but I'll definitely be on the lookout for that, and not just the likes of Goodman Group, NextDC, Macquarie Technology, Infratil, and there are a few other ones, but also the technology companies like WiseTech, for example, that will be applying AI through their operations. I think what investors need to realize also, and we've touched upon it a little bit earlier when share prices look elevated. In the US, there's the discussion in the US is much more lively than it is in Australia. And in the US, those who are convinced that AI will have a profound influence on the economy over the years ahead, they are toying with this idea that companies that will be successful, and they can be in finance, they can be in insurance sector, they don't necessarily have to be one of the big tech companies. They can be elsewhere as well. But if they are successful in applying AI, their revenue will go up and their margins will increase. If you have the combination of those two, then whatever is priced in today will not look expensive in 2 or 3 years' time. You know what I mean? And that's something investors should consider as well. And that will, again, I think in August it will be too early, but there will be early talk, and companies will talk a lot more about AI, I'm sure, and that will include the likes of CBA. It will include, I mean, I've picked up in recent times, even companies like Imdex are now moving into SaaS and AI. You will hear it from Promedicus, you will hear it from WiseTech, but you will also hear it from Center Group and from Maya and from Temple & Webster. So I think while August will be a season that will be a lot of talk about AI, but we won't see that much in terms of extra revenue and profit increases. That might be at the earliest probably February next year, maybe August next year.
Yeah, yeah. Do you have a couple of front runners on the AI front? You've talked about the data centers. I know you're a fan there. You've listed a cluster of stocks from bricks and mortar retailers through to the biggest bank, through to a mining services software provider. Are there a couple at the top of your list where you think they could be on the front?
Yeah, I think there's a time and a timing for everything. So I'm still into the data centers because that I think is still a very straightforward way of playing this mega trend. I think the most obvious at this point in time, the most obvious other companies are companies in which I was shareholder anyway. So you talk about Technology One, you talk about a Zero, you talk about a WiseTech Global, because they already are working with AI. It'll go through the databases, it'll go through their client bases, and given their business models, they probably will stand to benefit also quite straightforward and quite easily. I mean, the margins will probably increase there, the cost will go down. So they are the obvious ones to watch also this reporting season. I think in the next phase, we will start talking about AI being used in finance, so insurance companies, banks, probably also in other finance services providers. The telecommunication companies will start using it, but I think we can position for that right now, but it's still early days for that. I mean, as I said earlier, I mean, BHP is big on AI, but it won't move the dial there unless we see the copper boom coming to the surface, or potash or iron ore staying resilient for longer. Because at the end of the day, BHP can apply AI as much as it likes. If those commodity prices don't move, the share price won't move either.
Rudi, we usually have 3 regular questions, but I'm going to call them irregular questions this time around because I've tweaked them for you and ahead of reporting season. Meant to be short, sharp, a little bit of fun. So why don't we get stuck into those? You've analysed thousands of broker reports, maybe tens of thousands, possibly hundreds of thousands over the last 2 decades. But if you had to pinpoint one aspect, the most valuable part of that research, what is it and how can investors use it?
Probably the way I use it. It helps you understand what makes a company tick. And I think that is more important for someone like myself. That is more important than someone putting a sell or a hold or a buy rating on a company and coming up with a price target or a valuation. I think what helped me massively over the past 20 years that I've been doing this and longer is that if I come across a company and I have no idea what it does, or I mean, I can download an annual report or something, but often having access to broker research that have gone through the whole company from A to Z and back, you don't have to agree with everything they come up with, but it helps you understand what is important. I mean, this market, this product, etc., etc. And as I always like to say, Warren Buffett always says, you want to invest in a company that sooner or later can be run by an idiot. Yeah? And so you have to understand the company, yeah, to identify that particular company.
Yeah, very good. Normally we'd ask people what they think is, investors getting wrong about the market. This one, I want to ask you, which company do you think investors are underestimating the most in the market right now?
That's an easy one. I think that's NextTC. I mean, I recently had again a whole conversation with some investors, and it's I can't get around the impression that people really can't get their head around how the data centers sector actually works and why the world needs companies like NextTC. So it's maybe something I underestimated over the past decade as well. That I was quite lucky. Again, to have access to industry reports, to broker reports that explain to me how the industry works, why we need an XTC, why there is a mega trend and all of that. But I noticed that clearly for a whole bunch of other people, it's very difficult to get their head around. And then it's even more difficult because this is a company that doesn't make profits.
Rudi, last question. It's been about 15 months or so, maybe a little longer since you were last on the Rules of Investing. You were asked by Ali if you could only own one stock for the next 5 years, what would it be? You were a bit cheeky. You picked 3 stocks. Those stocks were Goodman Group, NextDC, and CSL. Are you happy to stick with those stocks for the remaining 3.5 years? Did you want to substitute one in instead?
No, actually. I mean, I know if you want to substitute one, it would probably be CSL simply because of the risk factor. But I still believe that CSL is a quality company. It'll get things right as far as what they can control. And the other elements is again, we actually now are making a circle to where we started this conversation today. People have to stop looking at Goodman Group as a property developer. They have to stop looking at NextTC as a capital-intensive business here. What they do have to understand is that we are most likely revisiting the 1920s. And in the 1920s, at the beginning of the wave upwards, at the beginning of societal change, at the beginning of the megatrend, the last thing you worry about is that you're going to overpay, because those share prices will be carried by the megatrend. It's called a megatrend for a reason. And so I know, and CSL will use AI at some stage as well, by the way.
If you were to switch out CSL, is it ResMed that you'd pop in instead of it?
I might pick ResMed, yeah, it is. Okay. For obvious reasons. ResMed also in the portfolio has sort of taken the mantle of CSL.
Great. Well, Rudi, talking of mega trends, that was a mega interview ahead of reporting season. Always great to catch up. I really appreciate your time and put your hard hat on. Best of luck for August.
Thank you. And don't fight yesterday's war.
Very good. Ladies and gentlemen, I hope you enjoyed that episode of The Rules of Investing, a special one with Rudi Filapek-Vandyck ahead of the August reporting season. Remember, if you enjoyed that video or the podcast, make sure you subscribe to our channels on YouTube or on Apple and all the major podcasting platforms. We'll catch you for the next one.